Hi, everybody, and welcome to this webinar hosted by Ambit Asset Management. This is slightly unusual for us. Usually, what we tend to do is a monthly webinar, which typically happens between 7th to 9th of the month, where we share with you the monthly returns, the view on the economy, the portfolio returns, etc., etc. But today it's a little different. The topic is a little catchy. It's a little different. What we are looking to do over here is to share with you why it makes sense on investing in equities, why it makes sense in investing in equities in India, and third is why it makes sense right now amidst the whole global uncertainty and the slowdown which has occurred as far as the GDP growth rate and the equity markets globally are concerned, why it makes sense to invest in small caps more pertinently than anything else. Now, just to start off, if you look at the global economy, clearly India is been in a green patch for the last couple of years now. We've been shining through amidst the entire ruin. Now, if you look at the global context over here this year, which is calendar year 2023, the global economy is expected to grow between 2.5 to 2.7%. And if you look at India, right, when compared to China, when compared to Australia, Japan, Korea, right, when you look at Mexico, Brazil, USA, Germany, and United Kingdom, we shine. We are right at the top of the league table, growing at around 5.7%, nearly 2x the global growth rate. And that's essentially what places India in a place which is much, much better than what its peers stand at. If you look at it, Fed and the ECB both have been tightening very aggressively for almost close to a year now, which has increased the recession probability in both US as well as in the Eurozone pretty dramatically. The probability as of December 2022 of a recession in US stands at closer to 60-65%, and that in Eurozone stands at closer to 80%. US economy is expected to grow very, very marginally by 0.5%. France in the same band. Italy is expected to grow even slower, and Germany and UK are expected to decline. And like I said, amongst all the other countries, including China, India stands out and is poised to be the fastest growing economy in the whole world. And this is primarily going to be led by three major factors. Number one is going to be our demographics. Now, if you look at the top 50 countries in the world, India is not only the youngest country with the average median population age of close to 27 years, but unlike China, unlike Japan, and some of these other Western countries, Indian population is getting younger by the year. Our population is still growing, which basically means that we have a huge demographic dividend. Almost close to 60% of the population lies exactly in the band of 18 to 59 years, which is a working age population, which is expected to continue to pay a positive dividend for us for the next couple of decades. And this essentially means that consumption is going to be a very long-lasting play in India. It is going to be one of the key pillars and central pillars of growth in India for the next decades to come, because as more and more people enter into the working age population, they find employment. And the context of the Indian economy changes from being more of a service-oriented economy towards more of a manufacturing-oriented economy as the PLI scheme and the Make in India kind of start taking shape, right? And as this manufacturing footprint expands aggressively, you'll see mass affluence coming through. By the time we hit 2026, 2027, not only are we going to be closest to a $5 trillion economy, overtaking Germany and then China and Japan to become the third largest economy in the world, but by that time, a per capita income would also increase from closer to $2,400, $2,500 to closer to $4,000, which basically means that by the time we hit 2030, consumption, especially more so discretionary consumption in India, is going to be closer to a $6 trillion opportunity. So it is demographics which is going to continue to pay dividends for us. It is the government action in terms of continuous capex, encouraging private sector capex through the Make in India program, the PLI scheme, which is going to drive this growth, and not to say that the agricultural sector, which continues to remain on a very, very steady growth path. So this is a context of the whole presentation that we are making to you today as to why does it make sense to invest in India. I realize that a lot of you would have questions regarding the returns in the equity markets, especially in the last 14-15 months, saying that we have not really done too much, right? We have not really done too much as a market. Nifty returns are almost close to flattish. We are still at the same place in terms of the market capitalization and the index levels where we were in September of 2021. And in that context, why look at equities now? The point basically, very simplistically, is that the economy has been on a very, very strong footing, which is basically meaning that last financial year, FY23, we delivered close to 7% GDP growth rate. Next financial year, we are expected to grow GDP by closer to 6%, 6.5%, which basically means that we are going to be 2x of the global growth footprint. And only thing that has happened is that the attractiveness of the opportunity has increased by multifold. What was cheap has actually become cheaper, and the index valuations, which were at closer to Nifty index valuations, which were at closer to 21x, have now become 17x. So the right time to buy is now. Those who are invested in the markets, my only submission to you would be to remain patient, to stay invested, and not really to get carried away by the short-term movements in the market. Now, having said that, if you look at the different asset classes that we have in terms of investment avenue, my firm belief is that if you are a guy who's looking to create wealth and multiply his money from the next 3 to 5, 10 years perspective, then equities is and will always remain one of the best asset classes to be invested in. Now, this is the return profile that I'm talking about when real estate market has actually improved very dramatically in the last 12 months, when gold is almost touching close to all-time high at closer to 60,000 levels, 2,200 levels. If you look at it in dollar terms, the bond yields have hardened very dramatically. And despite all of this, in the last 10 years, the returns from equities has actually been the best amongst all the different asset classes. So the right way to look at equities, right now that we have kind of covered the India part, the right way to look at equities is basically as a wealth creation tool where you buy good quality businesses and stay invested in them from a long-term perspective. It's all about trying to spend as much time in the market as possible. And the longer you spend time in the market, the more your wealth multiplies and the more money you make out of it. It's a patient man's investment. It's a long-term investment meant for people who are looking to create wealth in the markets. Now, coming down to the final frontier, which is why small caps, right? If you look at it, typically small caps tend to be unidentified. These are typically companies that are still a little in the nascency and infancy as far as the stage is concerned in terms of the market discovery, in terms of the product life cycle. The PE multiples are usually compressed. And what you need to do is to identify these companies early on. Companies that have the traits of being a market leader, companies that have the trait of basically being, in a leadership position, great corporate governance, good quality management. And if you stay invested in them, as they progress, right, from being in the small cap space to the mid cap space to the large cap space, what you'll see is a return that you'll make in these companies is going to be disproportionately higher. So what you need to figure out is that 3% and 10% of these small cap companies that over the decades have moved the brackets and moved up the ranks. And over there, if you see the return profile, what you'll realize is that they have actually made a disproportionately higher return, because not only has the earnings grown steadily, but the PE multiples have been re-rated very significantly and very massively over a longish period of time. And the best example we can give you over here is this table, where if you look at the last 5 years return from Nifty small cap. Now, when we have identified every single thing here so far, right, to set the context right, what most people will feel is that small cap is a high risk, high reward game. And in that context, you will have to be ready to bear some pain. The question is not always. What you need to do is to deepen your due diligence. What you need to do is to figure out the companies that are positioned in the correct frame in terms of the growth path, in terms of the management capabilities. And if you're able to do that, then wealth creation can be disproportionately higher. Now, if you look at from December 2017 to February 2023, which is roughly about a 5.5 year period, Nifty small cap index has delivered a return of only 7%. We are talking about a 5-year period invested in a highest risk asset class within the equity basket that you can think of, and you've been delivered only 7% CAGR return. Why? Because almost 45% of the companies have had negative earnings CAGR, negative return CAGR in the same time frame. Almost close to 38% of the companies have witnessed between -1 to -20% CAGR returns, and 7% of the companies, which is 55 companies, have witnessed a 20% or higher return in terms of the negative CAGR, right? So that's the whole point. And that's essentially the reason why you need to be invested in the top 13%, top 14% of the companies. Identify that 102 stocks out of 750 where you're going to invest and hold them from a 5-year period, so that you are able to outperform the market in a very significant manner, where you're able to get these returns which are 20% or above and compound your wealth. With that, what I'll do is I'll invite my very, very good friend Trilok to come and take us through the rest of the presentation. Trilok, the floor is open for you.
Yeah. Hi, good evening. Thank you, Manish, for the initial part of the presentation. Now, given the fact that
we are not able to hear you.
Okay, am I audible now?
Yeah, perfect.
Yeah. So yeah, given the fact that now that we have understood the fact that asset class equities remains clearly the most preferred asset class, and small cap hasn't given the kind of return that we have seen in the last 4-5 years. However, what is more important and what more critical to understand is, in small cap, early identification of the right businesses, investing in the right business. Am I not? Is my voice not very clear to all? I mean, could you just help me understand? Manish, am I? Okay, thank you. So, the fact that early identification of the business. So there are only two ways to sort of make very, very strong alpha. A, identify very good businesses at the early stage, or B, disproportionate allocate capital to handful of businesses. We believe we are doing a combination of both. And if you look at the last a few examples that we shared on this particular slide, early discovery of the businesses helps us create significant wealth over the period of time. Take, for example, PI Industries or RT or Algai. Both obviously in the initial phase when it's not well covered, the liquidity is a big challenge. Essentially, most investors tend to miss out on these names, and when the businesses do well over a period of time, along with good opportunity from a long-term perspective, it creates significant wealth for all investors. That's the way we think about the businesses on early identification. Moving on to next, if you look at what happens,
Trilok, I think just use the mic of the laptop and not the speaker.
Okay.
Your voice will be clear.
Okay. Yeah, hi. Am I audible now?
But
there's some echo. Yeah, a bit of echo.
Yeah. So yeah. Now this should be better. Sorry for the issue. So essentially, what I was trying to share is, if you look at the when you identify the stocks on an early basis, you end up making very strong returns over a period of time, and that's what we do. Allocation in the right stocks and early identification. Now, after all these element, why do we think now is is the right time to invest in the small cap? There are two most distinctive factors, despite the fact that small cap tends to deliver significantly better earning profile in a very long period of time. Typically 1.5 to 1.7x is usually the earning growth for a small cap companies. A, because of the size of the business, and B, because of the opportunity that that entails towards in front of it. Over the last 5 years, small cap has been given only 1.5% CAGR, which our friend Manish also highlighted, that only a 7% return has been delivered. Now, and to combine with the fact that now the Sensex, now the valuation premium is absolutely zero. In fact, small cap is trading at a discount to large caps, which is when you see on the right hand side, the 5-year cycle, it's a 0.95x over the long term cycle. So this obviously makes us very excited on the opportunity, because A, it will be driven by very strong growth, and B, valuations are very attractive. So these two combinations are rare, and whenever these combinations arise, you obviously make very strong returns going forward. Moving ahead, what is the performance? So if you sort of see the kind of performance the emerging giants have delivered, is excellence across the industry. Now there are two distinct factors that I want to like to highlight here. Every year, if you look at the year, almost every year our fund has delivered superlative returns against the small cap index. Importantly, in the years where the markets were very tough, where the drawdowns were deep, where the cuts were very high, our fund did exceedingly well, and our drawdowns were very limited. In fact, every downturn, the fund has come out in green color, flying in green color. And importantly, this also showcases the kind of quality that the portfolio has, and it consistently endeavor is to basically ensure that the quality of the portfolio is maintained with very low churn. And this obviously every doing bit by bit, year by year, quarter by quarter, adds up to a long-term performance from a long perspective, which should clearly showcase since inception we are almost 2x the benchmark in performance, and almost 1.5x the mutual fund average. That's just to highlight. Moving on to next, this is very important. So one is performance, second is consistency. If you just look at the data, there has been 9 instances over the last 5 years, within 20 quarters, where the indices or the performance have been in the red, and there are several factors for the same. However, out of these 9 instances, our fund has done exceedingly well, or have beaten the respective indices 8 times. So this is like 90% of the time we have done better than the indices in a situation where the markets are in red, which clearly showcases the strength of the portfolio. Also, when the market does well, it also participates on the upside. So you enjoy the best of both the worlds. This is one. Moving to this one, we are trying to showcase one of the client portfolio invested with us. Now there are two important takeaway from the slide. One is the duration of the investment that he is with us, and second is the kind of return that they generated. Apart from the fact that the IRR is 2.5 times the benchmark or the relevant benchmark returns, and almost 1.8 times the large cap, the nifty so-called returns. The fact of the matter is, we all know the markets are never linear in terms of returns that they deliver. So if you look at FY 2020, the returns were exceptional, where the market, returned 30%, where the fund returned 60%. So it's like 2x. Similarly, in 2021, when the markets went berserk, when everything did well, right from the jewel to sort of, the rags to riches, everything did well. Our fund still wasn't, far behind not to participate on the upside. To sum this, overall perspective, there are two things. One, returns are not linear, so you have to stay invested to enjoy the upside and not, get out when the downside comes. So last 18 months have been tough. It doesn't mean if somebody moves out now, will obviously miss the rush when it starts. And B, the most important aspect is that the portfolio churn is exceedingly low. It's only a 15 to 18% churn versus. In fact, I joke, we have sometimes conversation that index churn is greater than a portfolio churn. In fact, every, 5 years, index churns, by 25-30% of the portfolio of the, index constituent. So yeah, that's one of the, key highlight I want to share on this particular portfolio. Moving on to next, how do we do this is the most important question that most people, end up asking. So clearly there is a clear framework of, how do we invest in a particular stock, and there are several, but we would like to highlight only 3-4 most important parameters. One is filters, quantitative filter that we apply, extremely strong research team that we have internally, along with the cumulative experience of the fund manager as well as top management in our business. We obviously only are obsessed with focusing on good quality business with strong earnings quality, and utmost important is managing the risk very, very importantly, because great businesses and great companies also see large drawdowns when the risk is not appropriately managed. Moving to sort of the most important sort of aspect of how do we select a particular stock. Now there are several important elements before we jot down to a particular investment, but two most important of them is, one is good capital allocation is the most important parameter, and second is quality of the business. How do you assess quality? You assess the quality based on the accounting policy, the auditor treatment, the banker, the governance, the independency of board, the director, and so on and so forth. There are several factors. These are the two most important element that we use before we invest in a particular company. That gives us a handful list of quality sort of filter gets narrowed down, and we get a good fair sort of universe of good stocks. And then we further jot down into businesses which have long-term opportunities, strong leadership skills, ability to scale up, and execution capability with minimal or zero leverage in order to succeed. So this is how we jot down to the handful of 15 to 20 companies in the portfolio, and then we invest and we review and always validate our thesis on why we invested, at what stage are we, and then we, if required, if we think that the business is making some changes, or if we think the growth is kind of now tapering off, only then we sort of move and do some churn as required. Or in some cases, valuations went far ahead of what the fair value would have been. Now, this is the way we think, in context of how do we shortlist the stock. Moving to the next, we just want to highlight another important element of how do we identify, how is a good and clean framework identify winners early. So, we believe that there are two most important things to invest in investment. One, don't lose your capital, and B, let the good capital run its own sort of compounding. Now, in order to ensure we don't lose capital, you have to avoid the bad ones. And in order to avoid bad ones, or avoid the losers, as Manish explained in the earlier slide, 45% of the business of the index have lost money in the last 5 years. We have a fairly reasonable amount of checks internally, whether it's accounting checks, it's P&L, balance sheet, pilferage, audit related stuff, or the kind of capital efficiency that the business has, or the balance sheet efficiency, along with the cash generation, and also in context of the discipline that the company or the management maintains. So this obviously framework allows us to eliminate the weed out of the weed out of the system, and also differentiate the wheat from the chaff. That's the framework that we sort of wanted to emphasize. Moving on, we invest in companies where they end up becoming a leader in the particular category if they are a challenger, or they gain further and further leadership in the existing categories where they are already leaders. And that's been our history of investment. And if you look at the business that we are invested are typically either leader or challenger, and there's not a very fragmented market, because if that's the case, we end up sort of not getting a meaningful alpha or meaningful growth potential going forward. Or even if they end up growing in a very fragmented market, you don't make very optimal capital efficiency. That's the sort of investment, and that's how we identify leaders and winners in each of the industry categories. Then moving on to next, I think this next, please. I think so. Yeah. No. Yeah. So, and this is important slide I would like share. When I highlighted about the risk management, which is important element of fund management as well. Now there are 2-3 important things I would like to highlight. One, despite the fact that our earning growth profile of these companies that we are investing is 1.5x of the benchmark, or the relevant benchmark, or small cap indices, our multiples are not as stretched as a benchmark is. Second is we avoid, or we actually have no exposure in leverage companies. In fact, we invest in net cash companies versus a leverage, maybe the universe or even the benchmark indices, and that helps investing in a company with a far significantly better capital efficiency. In fact, to the extent that our portfolio is almost 2x return efficiency versus the indexes itself. This obviously percolates into the fact that we have a very low volatility in the index, in our portfolio, with the minimum with the minimum beta. And importantly, in order to perform, we allocate capital irrespective of the market. So a lot of indices, or the lot of even peers end up investing in all sort of market capitalization in order to achieve the outcome. But our thought process is process driven, and 90% of the portfolio, I repeat, 90% of the portfolio invested in small cap, and only on a 3 to 5% is invested in mid cap. And those mid caps also have become from small cap to mid cap. Not that we identified and invested in mid cap, they actually have grown over the past several years. And importantly, in small cap, to diversify the portfolio into various sectors is another challenge. Now, as you can see on the slide, our portfolio's allocation is very well spread out across sectors and not concentrated to any particular, or not skewed to any particular sector, which also helps us to mitigate our risk profile in case of any adverse event unfolding. Moving on, I would like to just highlight 2-3 of our strong ownership companies. And usually, however long or whatever I may talk of may not necessarily convince you as much as the past performance does. If you look at clearly 5 and 10 year performance of these companies, I'm just taking in this example Safari Sera and GMM, the revenue and the PAT sort of CAGR has been exceptionally strong, with 15, 23 and 15%, 23%. In Sera again, 16 and 17%, and in GM also 25 and 23%. But look at the market cap, or the wealth creation this company has delivered over the last decade. Safari has grown like 35x, so Sarah is 15x, and GM is 50x. So these are, the real benefit or the real sort of implications of identifying, stocks early, holding on to them, and enjoying the ride until it, till the time the companies deliver a strong performance continuously. With that, I would like to sort of, hand over the